look at the underperformance of the NASDAQ, that really stands out for the week, down 1% while the S&P is up 1%. Is this a rotation that's going to continue after the NASDAQ had been hot leading in?
We have been looking for that. We were expecting to see a rotation come around. And frankly, what most of our clients are asking us about in the face of these choppy markets is what should they be doing? So it's less so looking specifically around where are we with these tech stocks versus the mainstream. They're really looking at, okay, well, how does this impact me? And how should I be looking at these markets from today going forward? And what should I be doing? And we've been really focusing and looking at two things. One, protection, because we've got to build an insurance. We're leveraging options. We're using put strategies. And secondly, we're looking at distressed and stressed assets. I was at Lehman Brothers, actually, back in 2008. And I can tell you, those funds that were picking up the Lehman bonds post-bankruptcy at pennies on the dollar did fantastically for their clients. So we're looking really at how do we look at these markets and how can we position our portfolios accordingly.
Keith Bliss, just looking at the list of week-to-date performers from the banks, Citigroup, Wells Fargo, Bank of America, US Bank Corp, all ending the week lower by 2 or 3%. Are you concerned when you see that and patch it up with the tone we got from management this week about the outlook for the economy and the broader markets?
Yeah, I am concerned about the financials. I think the bigger banks, as well as some of the regionals and even some of the community banks that are publicly traded, will have a tough road to hoe going forward here. You've got their business clients that are still suffering a little bit. They're raising their reserves pretty dramatically in the last quarter. They're anticipating charge-offs coming. The net interest margin is still not there as we live in a negative real interest rate environment. And unless you're a big trading shop like a Goldman Sachs or a Morgan Stanley that's able to dabble in the capital markets, also have some investment banking, maybe merchant banking activity on the private side, I think it's going to be tough for banks like Wells Fargo, who have a very large retail base. Yes, they will capitalize a little bit on what's happening in housing and the mortgage trend, but their core businesses are going to really lag for some time. I'm not sure that I would be in this sector for the remainder of this year.
I wonder, though, if it goes broader than just the banks. And I mean, they're looking at their clients. They have such a unique view into the economy, both from the corporate sector and the consumer sector and the bank accounts and the credit card spending. This quote, Wilfred, stood out to me the most reading all the bank commentary from Michael Corbat, the Citigroup CEO. I don't think anybody should leave any bank earnings call this quarter simply feeling like the worst is absolutely behind us and it's a rosy path ahead. That sounds pretty pessimistic. I mean, Steve, what does that mean for the rest of the earnings season and the companies out there ahead and the data that we're about to get?
I think for this earnings season, it doesn't necessarily tell you that much because the expectations are so far across the board and there's so little consensus as to what good and bad is. I think it actually bodes very poorly looking out a couple of quarters because the banks are the canary in the coal mine. If Michael Corbat, if Jamie Dimon, if these people are putting aside $28-30 billion or more in terms of bad loan provisions, there's a lot more to come down the pipe. Now, you can argue that this bias is toward the top-heavy stock market that we're seeing because the loan loss reserves are not necessarily going to be applied to the mega caps that are dominating the indices. But I think this does not bode very well for the economy as a whole because these guys have the best read on the pulse of the economy, and they're telling you the patient is not all that healthy.
Angela, where do you stand on the U.S. banks?
I agree with my colleagues. The fact it's always a big signal if you have these ginormous loan loss provisions. You add that into a very, very accommodative Fed. We're seeing policies never seen before, and we're about to probably see another stimulus program. I don't know if it'll be north of $1 billion, but it's definitely something to worry about. And that's not the other uncertainty, that the banks are signaling uncertainty, but we have elections coming up. Talk about a big level of who knows what's going to happen if we have a change in the administration. What's that going to mean for stocks, and what's that going to mean for how we're looking at our long-term outlook? If we have the blue sweep, likely we'll see tax rates change. We'll see a repeal of some of the tax reforms. That means for our clients, we've got to start thinking about planning. We've got to look at what are our trust and estate, what are our trust and estate plans? We need to revisit them and rethink them. We also have to think about if there's a blue sweep, what does that mean for green policy making? And that's pretty good for ESG. But ultimately, looking at the banks, I think I agree. Canary in the coal mine, this is a signal of hard times to come.